Hello, this is the Albert E. Sharp Model Portfolio Performance Report to July the 31st, 2020. In this video, I'm going to discuss our regular platform models over the last month, but also for the first time talk about our model portfolios where we arrange custody. This follows our finalist position for investment performance in the growth category at this year's PAM Awards. And having put in such strong numbers over the last 12 months and 3 years for that matter, we are anticipating that this nomination will be the first of many. Hi, my name's James Crocker and I'm a partner here at Albert E. Sharp. I oversee the model portfolio service that we operate for financial advisors across the UK. As usual, I'll be looking at the risk-rated model portfolios that we run on the various platforms this month. But also towards the end of the video, I'll talk a little bit about the model portfolios where we arrange custody internally. If you're an advisor looking for an equivalent platform fee of below 0.1% with full online client reporting, security of assets and full backup from the Albert E. Sharp team, then this may well be of interest to you. But first of all, let's take a look at the numbers on the platform models for July. As you can see, of the Arch benchmarks that we use, 3 of the 4 were in negative territory during the month, with equity risk off 1.2%, steady growth down 0.9%, and the Arc balanced just 0.4% lower. Cautious was flat. I should point out at this stage, these are all estimates, and they will be subject to change. In contrast, all of the Albert E. Sharp models were in positive territory, all by a very similar amount of about 1.1% or so. Also remember, this is net of fees, assumed to be 0.6% per annum, and they also aren't estimates, they're actual. So during July, the UK and European equities were generally lower, with the rest of the world in positive territory, with fixed income seeing yields contract generally, particularly in credit. Maybe the most noticeable move was in the foreign exchange markets, where we saw a 5.5% recovery in sterling against the dollar, which was almost the same as the rise in the S&P 500. So as a result, a couple of our US holdings were pretty much flat over the period, with one very notable exception, and it was the 8.2% rise in the Bailey Gifford American Fund. Had the dollar been flat, all else the same, this would have been a gain of almost 14%. Now, with Shopify, Tesla, Amazon and Wayfair as the top 4 holdings at the Bailey Gifford Fund, all of which have had an amazing run over the last 3 months, there's no surprise that this fund is now up 67% since the start of the year. Now, in the chart, I've also put in the FTSE All Share, not really as a comparison, but really just to highlight the importance of opportunity cost. Over the last few months, we've heard countless investment managers tell us that they've maintained an overweight position in the UK because it, quote, looks good value. Never mind the quality of the companies in the index that are at best variable. By principally getting drawn into a valuation debate, they've completely missed out on the incipient post-COVID-19 stories in Wayfair and Shopify. These 2 companies have been huge beneficiaries of the crisis, and they look set to continue to do so. This really is why we like the team at Bailey Gifford so much. They go to where the action is. As Wayne Gretzky, the ice hockey player, once very famously said, sometimes you have to skate to where the puck is going, not where it has just been. And it's another example of home bias, a behavioural trait and an error that is inherent in our industry. Now, this links nicely to the Fidelity Emerging Markets Focus Fund, which was our second biggest riser in July, up 3.6%. This is run by Alex Duffy, and it isn't the flagship emerging markets fund at Fidelity, but it is a fund that we have very, very high hopes for. We think Alex's approach is distinctly different from a lot of his peers, and we like his focus on good corporate governance. This is central really to how we see the world. It supports our view that if the G is in order, then the E and the S will tend to naturally follow. That is, if governance is decent, honest and above board, then environmental and social aspects of the business will naturally tend to be in order too. Now, ESG is certainly a subject for another day. But if this is an area that interests you, please get in touch. We'll talk through our philosophy and walk you through our suite of models happily. Also, keep your eyes open to our YouTube channel. There will be a lot of videos appearing on this very subject in due course. Really, one of the main reasons I wanted to bring up emerging markets here was a general observation that many of our peers' equity weighting across this broad region, and Asia for that matter, appears to have noticeably slipped back over the last 18 months or so, and a few really have practically zero exposure. Is this a reactionary move because of lackluster prior performance? Is it a currency call? To what extent is it the trade war with the US relevant? I don't know, but what I do suspect is that being on the wrong side of this trade could prove to be very costly over the next few years. A final little remark on attribution here. In July, we had a much stronger return from our funds with exposure to corporate debt or credit, and it coincided with government debt, particularly at the short end of the curve, really trading sideways. And again, I can't help but notice that many of our peers in the DFM world continue to hold a very high weighting in gilts, US Treasuries, and mostly in an index tracking form, and that tends to be long dated. We continue to worry that this carries far more risk than is generally appreciated. Now, in contrast, we have much larger exposure to the long-short equity funds that are totally uncorrelated, and they provide a lower risk return profile. Well, if you pick the right fund, that is. And so far, the approach has worked really very well for us, and definitely over the last 12 months. In which case, as you can see, our numbers continue to be amongst the very best in the industry. Brings me on neatly to the news that we recently made it through as a finalist in the growth portfolio in the 2020 PAM Awards. Specifically, this was for our Model 6 portfolio in our best thinking suite of portfolios, and this is different to our platform models. Until now, I've only discussed our platform models in these videos, mainly in the interests of time, but quite simply, as the name implies, these models are available on the main platforms such as Standard Life, Transact, Novia, Nucleus, etc. Now, there are several very good reasons for wanting to have your portfolios held on one of these platforms, but there is one drawback, and that is the availability of certain funds. Now, most platforms have a list, and if the fund you want to buy is on it, then fine. But if it's not, it's a waiting game, and it can take a very long time, often months, to go through the paperwork to get it on the list. To be fair, this isn't often a big problem, but at the margin, it restricts the universe of what we can buy. However, where we arrange custody ourselves, we can buy what we want. Paperwork for new funds is done in a matter of hours, and so our universe is effectively boundless. And this is why we call it our best thinking suite. Actually, it isn't hugely different to the platform models, and the performance of late has actually been pretty similar. But what we enjoy is the flexibility, and we have much better ability to deal in investment trusts, get access to specialist share classes sometimes, often where we can hedge against the currency, for example. Now, more recently, we've been able to deal directly and buy in some US funds that we really liked, that were provided by some very specialist, very niche managers based across the pond, but with no platform coverage at all. Of course, for a very long time, the US has been a bit of a problem for a lot of UK-based fund selectors who simply could not find a manager with a decent track record of outperformance. And to be fair, we've struggled a little bit as well with a very small shortlist of candidates, which is why this is the only area that we are less reluctant to hold an index tracker. Well, maybe until now. Now, I apologise, I'm not going to reveal any names here, but we've recently added a fund with large cap exposure. It is the orange line in the chart that has nicely outperformed the S&P 500, which is the black line, over the last 5 years, and in fact well beyond this. And we see no reason why this is going to change anytime soon. The numbers really are very persuasive. In the small cap area, we've also found a new fund that fits our style and philosophy perfectly. It's also performed incredibly well. The purple line here is the Russell 2000 Total Return Index, which indicated really that large cap has outperformed over the last 5 years, as most people will know. But in contrast, the green line is the fund that we have recently added to our portfolios. Obviously, we wish we'd have stumbled across this 5 or so years ago, but to be fair, we probably wouldn't have actually been able to buy it back then. Besides, we don't think the game is close to being over here, and we see no reason why this level of outperformance shouldn't continue for the next 5 years. The point to repeat here is that these funds are simply not available on the regular platforms, well, not anyway at least, and these decisions could just give us the edge in the performance stakes. Don't forget, this is a race that we are unashamedly aiming to win. Now, just on a practical admin note, if you're an advisor out there are several considerations about going down this route for your clients. One that might be of interest is the custody fee, which is below 0.1% per annum. Another is that it is all backed by FIS Global, the largest provider of this type of service in the world today. Please get in touch if you would like more detail. You can contact me directly, james.crocker@albertesharp.com, or Alistair Power or Mark Atherton, and they will certainly be able to help. So on that note, if you found this video useful, please subscribe using the button below, or have any questions or observations, please leave them in the comments below. Thanks for watching, and I'll be back very soon with the performance numbers to the end of August 2020.